calling in.
Squawk Box. Ilya's our Joe Kernan around here. Please treat him as such. We'll be with you for the next hour till 5 Eastern, 4 Central as we wrap up the trading day. If you're on the platform Tasty Trade on the website tastylive.com, welcome. Come over to YouTube. Tell us what you think of this action. The sell-off that was sparked by price pressures going up. Does that mean inflation is coming down the pipeline for the consumer? Stocks take it on the chin initially, but when we turn to our charts, we see a recovery during the day. And sure enough, the S&P 500 here basically back to break even after a big sell-off this morning, getting down below 64.55. NASDAQ off by 0.25%, Dow off by 0.11%, the Russell, the big loser, off by 1.4%. It's a bad day for the cryptocurrencies as well, which are down 4% or so each. We take a look at gold and silver, which are sliding, but it's good news for the US dollar because higher treasury yields ultimately lead to a stronger currency. So as we break this down, Ilya, we need to talk about this inflation figure because the PPI did spook the market today everywhere. If it was stocks, if it was bonds at the long end of the curve, those never quite recovered. If it was gold prices or silver even, PPI comes in and the market gets weaker.
Yeah.
President Trump said that inflation's hardly here. Direct quote, said today.
Yeah, okay.
What's the real story here?
We've been talking about this for months, right? This idea that CPI is not an accurate reflection of what's actually happening with the tariff impact on inflation, not because the data is fuzzy, which it is. It's fuzzier than it's been in years. But that's not what's going on.
But why is the data fuzzier now than it was a year ago?
Because we have about 30% imputed data in CPI. That's the highest in known memory.
Imputed even during an inference?
Yes. Even in COVID times, it got to maybe 15, 20% while everything was closed.
And why is the imputed data so high at this particular point in time?
The imputed data is so high because they don't have the staff to collect it because a madman with a chainsaw
they're not collecting it.
Because they're not collecting it. That's right.
And the imputation fall off starts in, or rise rather, starts in March, which coincides with Doge.
Yeah. So the data is fuzzy, but that's not what's going on here. What's going on here is in the first quarter, we had a massive jump, as we all have seen, in imports and in inventories as everybody was trying to front run the tariffs. In other words, people have built up these inventories to try to get as much as they can before things get expensive. And that's shielded consumers because inventories have these goods at the former costs. And until we wind those down, we have that as a shield. The other major shield that we've been watching has been wholesalers eating into margins to protect consumers because they want the tariff thing to sort of wash over them without destroying demand because nobody knows what's going on with these tariffs in recent months. They're here, they're there. And so wholesalers make the bet that they don't want to kill demand by passing on these tariff costs. They want to eat it on their margins for a little while and see what happens. And that's been the story really going back to when we had a really massive surge, a month-on-month 2.1% surge in these costs, especially early in the supply chain, intermediate demand. So a 2% decline in margins there, going back to shock of shocks, April, when Liberation Day really hit the fan. What we see here now is that the pass-through is occurring. And that's what is so worrying about these numbers, these PPI figures. Month on month, there is a surge in margins for wholesalers. Final demand, a surge of 2%. That's the biggest monthly increase since March 2022. For intermediate demand, biggest surge in 4 months, 1.3%. What does it mean that their margins are increasing? It means they're no longer eating the input costs. They're no longer taking it on the chin. They're passing it down to consumers. We saw it in the CPI numbers a little bit already, and for the past 2 months. And of course, we've also seen it in spades in the second quarter GDP numbers, where imports stopped, essentially. They just hit a wall. And inventories have started to come down. That is to say, businesses are spending down these inventories. They're not restocking them. And so the one-time front run is done. Now consumers have to face these costs. Those same GDP numbers told us the first 6 months of this year were the weakest contribution from consumption since the first 6 months of 2020, the COVID recession. So we're already in a weak spot. And as we've seen with the CPI numbers, the pass through is only just beginning a little bit. So we still have all of that in front of us. Now,
but the bottom line is, does this really affect Fed rate cut expectations? Really? I don't think it does.
It did a little bit today. The really interesting bit is I don't think this changes anything for September or this year. Those expectations still north of 90% chance that we get the cut. Now it's a slight possibility that we don't, about 6%. Yesterday, there was a slight possibility that we get a jumbo cut, about 6%. But the central idea that there is a cut of 25 basis points that's coming in September, that's unbothered. The biggest issue is what happens next year. And there, things got more dovish today because the markets see where the economic pain here is going to come. It's consumption.
So one thing that sticks out to me in the data, so now that we have CPI and PPI, right, we can basically take a look at PCE. PCE is the Fed's preferred gauge of inflation. If you take a look at the inputs, the head of fixed income over at the chief fixed income strategist, I should say, over at Janney, Guy Labas, apologies for the mispronunciation. He imputes PCE, core PCE at 0.56% month over month, Ilya. That's probably not a level with which the Fed would be comfortable cutting because that gives you an annualized inflation rate north of 6% from how they measure it.
Yeah.
Here's why I can't necessarily take that at face value. One of the translations that Guy points out here is that investment advice, insurance, portfolio management are some of the largest drivers of why PCE is going to be higher. And that's effectively a function of the fact the stock market's up. So PPI being up for
say that
a
again,
chunk of
why they're saying why is the stock market up? What are they saying?
No, so the way that PPI is measured, rising asset prices filter through into the higher cost of financial advice. So if equity indexes go up, then the cost input for receiving financial advice has increased. And when stock prices go down,
because the cost of financial advice is a ratio of basis points against the value of assets, basically. So as the asset value is higher, the cost of advice is higher because you're paying 50 basis points on the collective value of equity, or some number, an advisory fee on. Okay.
So like if the Fed is looking at this PPI impulse and saying, sure, there's a whole chunk of it here that's driven by things that aren't great, like food. For example, we now have a 9% effective tariff rate on bananas. We've really never, ever tariffed bananas before. Do you know why? Can't really grow them here. So there's no reason to tariff them. We're not going to incentivize American production of bananas or coffee for that matter anytime soon. But coffee prices have shot up. Banana prices have shot up. Food prices are going up. But when you think about everything that goes into the Fed's preferred gauge, you're not exactly landing in a place where, portfolio management, that's why this is a big, let's take a step back then. Will the Fed cut in September, Ilya? Probably.
Yes.
Should they? No. But our job as traders is not to make bets on what we think the Fed should do.
Right.
Because what the Fed should do a lot of the time is a day late and a dollar short. They're always fighting the last battle. What they will do is an entirely different equation. And I can't help but think that's one of the reasons why you have an S&P and a NASDAQ that are able to respond and rebound over the course of today's session, even if they're still slightly underwater here going into the close.
Yeah, I mean, I think the bottom line here stands. The markets want the September cut. They think the September cut is coming. They don't think this upsets the apple cart. The larger issue here starts to be, okay, you saw the jobs report was weak. Clearly. You saw the GDP report told you to worry about consumption. Clearly. You saw that same GDP report tell you that wholesalers were going to pass on these costs because they're not refilling inventories. So they find this stuff expensive now. Clearly. The question becomes, is the economy already rolling over and is the Fed already late? That's the biggest threat, really, because the markets have been saying for months that the Fed doesn't need to worry about inflation. And the Fed's concern, let's be clear, wasn't so much that we're not going to get a one-off uptick from these tariffs. Their attacks on imports, of course that was going to happen. Of course that's coming. 1 + 1 is 2. The larger question is, will consumers take that increase, extrapolate that out into inflation expectations, and thereby poison all of the progress that the Fed has made in bringing inflation expectations down and re-anchoring them through pain of significant rate hikes in 2022? And the markets have been saying this is the wrong thing to worry about basically since April, when the whole kerfuffle occurred. And you can see it because inflation expectations in the bond market haven't really gone very far, even as sentiment has recovered. So it's not sentiment about the economy that's recovering. The price impulse is still just as weak, pretty much, as it's been when we were concerned about the tariffs hurting growth February to April. We're still there. The question is the U.S. going to self-immolate and exit its own financial order and crash the whole thing? And the rebound in stocks tells you that we no longer think that that's what this administration is doing. And good.
You know what's really funny to me, Dylan? There's a word that we haven't tossed around here in a long time. It starts with a T. Transitory.
Yes.
We're starting to see the contours of a certain group of people in financial markets make the argument that, yes, inflation's here.
But it's transitory, baby.
But it's not going to stick around, and the Fed needs to be more concerned with the labor market, in which case, that's fine. That can be your view. But you're arguing that the data that we've seen today and this week and in recent weeks of inflation nudging up, it's transitory. So make that argument.
So can I take a I'll make that argument right now. Let's take Trump at face value. He said more than once that the tariffs are actually not about, I mean, the tariffs may be ostensibly about sort of bringing production back to the United States, but I would say more substantially what I hear Trump say is we should pay, we being Americans should pay lower income taxes. There should be a lower general average tax rate on income and on capital, and that we should gather our tax revenue via a different mechanism, which he believes should be done through tariffs. And so the question to the transitory piece is maybe the hypothesis would be that the Trump tax bill is a move towards a reduction in taxes on capital and income and an increase in taxes on imports. And that you're basically that it's not so much of a reshoring or not reshoring, although there's some marginal aspect of that, although obviously not with bananas or coffee, but that bigger than domestic production versus foreign production, that it is a philosophy on tax revenue collection, full stop, that is to put more money into the pockets of Americans by way of lower income tax and lower tax on capital, and then take more money from Americans effectively when they buy foreign goods by way of higher priced foreign goods. And so the question would be, is the transition to higher taxes on Americans when they buy non-American items, French wine or German cars or, whatever, bananas from South America, what's the net effect of the marginally higher prices on any foreign good relative to the increased accumulation or retention, I should say, of income by virtue of a reduction in income and tax and capital gains tax? One would, if you believe that whole thing was going to shake out, which seems to be a tenuous belief to hold, considering how many moving parts and how much money and how many people and how sort of asymmetrical and selective and targeted and preferential to his friends and all these things. But one could argue that it's transitory because while the cost of foreign goods will be higher, that the amount of money in an American's pocket will go up by virtue of marginally lower income tax. And if Americans buy domestic goods with their increased retained income, and then they pay more for foreign goods, that the tax rolls work themselves out. And in the process, also, you end up with a bias towards buying American and reduced overall tax rate on income and capital.
I see the argument, but to me, it seems like a bad one.
Why?
Because you get a tax reduction once a year. Meanwhile, you're facing the costs of these inputs every day, and it's not just bananas. Let's say you stop eating bananas, whatever. But there's inputs to everyday items.
I will not be stopping eating bananas, for the record.
Neither will I. But the obvious decision not to buy foreign goods is not so obvious, because foreign inputs are in almost everything, including, for example, American cars. So there's the argument that you can, sort of save yourself some money by not doing that, but that's not easy, nor is it clear cut. That's one thing. And secondly, you face these costs every single time you go to the store, every single time you buy something, whereas your lower tax take gives you savings once a year. And so you have to trust Americans then that they are going to retain those savings to paper over their future extra tariff costs. Is that realistic? No. That's ridiculous. And so when you look at the net effect here, the pain from hitting consumption, the biggest contributor to overall economic growth, is every day and all the time. And you're going to countervail that by giving somebody a break on income taxes once a year and hope it evens out. That's, to use a recently used term, bananas.
So if that's one side of it, right? Like the tariffs are inflationary, but it's only temporary, so it's transitory. Fine. But if it's not transitory, inflation's turning up.
Yes.
And we're going to be getting a Fed cut in a bump in inflation cycle. Now, the labor market weakening, not weakening, you can look at the claims. We can adjust it for labor force participation, however you want to slice it. But this is not the comfortable backdrop of the Fed saying, okay, inflation's coming down so we can glide into 2%. And we better start cutting now before we get there. Otherwise, we're going to overshoot. And that's going to be a different problem. This is not that world. So I'm very much for Dylan today. Obviously, stocks pull back in a little bit, but there's a resiliency here. Ilya, you and I were talking before the show went on. This is a nice little rebound here off of the former high that we had back in July in ES, in NQ, in the Russell even, which is holding up here.
I'm most interested in here.
Okay, so I did mention this comment on air today, and I've talked about it recently with you guys, but Zero Hedge made the note that the only rational thing to do in times like these is to swing wildly from one extreme view to one extreme view. Perhaps I'm going to put myself at risk from doing that here. But the regime change that it felt like we were going through the past few days in stocks, small cap over mega cap, value over growth, Russell over NASDAQ, that was out the window today. And I know Tom and Tony were talking about that towards the end of last call before we came on air. So Ilya, why do you see this as a good opportunity if we see that these firms with the smaller moats clearly have price pressures coming through? And these are not the companies with the margins and the moats to absorb those kind of costs.
So as we were just saying, the markets have been saying for a long time that the problem here isn't cost, that it is in fact going to be a one-time increase, but not for good reasons. That what's going to happen is these extra costs are going to hit demand much harder and what's going to happen is disinflation because of the demand destruction that these tariffs wring out of consumers. Basically, the increase in prices will get consumers to stop buying to the kind of extent that they have been. Again, we already have weak consumption in the first 6 months of the year, and very weak by historical comparison. It doesn't take much as you get the pass through from this inflation in the wholesale to the retail to hit that even harder. What's interesting then is the Fed is on course to cut to fight this. And Russell has been particularly sensitive because it is cyclical more so than the S&P or the NASDAQ, because obviously...
Let me just jump in here real quick. Applied Materials had their earnings come out a little while ago. We missed this at the top of the hour. EPS came in at 248 versus 236 expected. Sales were a little bit better at 7.3 billion versus 7.21 billion. They're missing guidance substantially. They see Q4 net sales at 6.2 to 7.2 billion. The street forecast was for 7.32 billion in guidance. So Applied Materials here now down after hours. This is an 11.5% loss on the chart. Go ahead, Ilya.
Yeah, ugly, to say the least. Russell,
but I still go back to what I said to Tom at the end of their show, which is that the only thing that stands between this market and a continuation higher is anything that would prevent, basically, I guess, be a hot CPI in September.
Well, right. So
anything that would jack
this is where it
expectations
gets
back.
Yeah.
Well, and this is where, as we were talking about that at the end of last call, this is where the parallel of the jobs report is interesting. Stocks hated the jobs report, even though it ostensibly paved the runway for rate cuts by being god-awful. Because what the markets want is not a recession. And what they don't want to see is that the Fed is already late. Even though they've been screaming at the Fed for months now. You got to go, you got to go, you got to go.
Polls show that the bottom 30% of income earners in this country think that we've been in a recession for the past few months based on their own personal finances.
There you go.
And consumption, we know in the first half of this year fell for only the first time since COVID. And prior to COVID, you have to go back to the first half of 2010, which Dylan, I was still a little green behind the ears getting my career started, but that's on the other side of the financial crisis.
Yeah.
And that was the time, Radigan, right? When going into the second half of 2010, people thought we were going into a recession again, back to the depths of the global financial crisis. So first half of the year declining consumption, that's a unique occurrence that is just difficult for me to shake.
No, I get that, but I mean, I'm at a moment right now, and who you can take it or leave it, where my confidence in recession forecasting or consumer expectations, I think, are basically useless. We spent 2023? We spent one of these years in the past couple of years with everybody expecting a recession, or at least including me, and it just never happened. Which is not to say that recessions don't happen or won't happen, but I just don't believe that sentiment. I think the only relevant thing is jobs number, CPI, PPI, and the AI supernova and rates. And I think everything else that's not rates, that's not, cost of goods, that's not employment, and that's not the supernova is useless.
Well, I think this is the key then, because we get this weak consumption. We now get evidence that the costs are being passed through from wholesalers to retail.
Totally.
Yeah. And now we're going to get retail sales numbers. So and then you're going to get another jobs number and another CPI, PPI. Right. But the retail is tomorrow. So if this follows the model of the jobs report and is ugly, stocks are going to sell off even though it paves the way for rate cuts, because that's not a level of intensity they want. They don't want rate cuts for recession reasons. They want rate cuts for the Fed is going to be a little bit more of a risk taker and be a little bit more forward looking and try to head this thing off. But everything we've heard from the Fed is that's not what they're doing. So this is where it gets interesting. If you get a mildly cool retail sales number, the markets probably go, oh, goody, rate cuts. If you get a decent retail sales number that isn't a blowout, it's probably the same. So if you're somewhere in the middle of the distribution, the market's probably like that. But any kind of tail risk, anything super hot that really eats into rate cut expectations, probably not good. Anything super bad that gets recession back into the headlines, that's not good. At least that's the story from the jobs report here. What did the markets love so much this week? A nothing CPI report that you could read each way you like. You want to look at core and be afraid of inflation? There you go. You want to not be afraid of it and look at the headline? Enjoy. Choose your own adventure. That kind of middling, vague, smoke and mirrors data, that's what the market's like here.
But can we just go to forget just anecdotal fact? We know for
sure, yeah, and Dylan, I have that up here. I actually have that up on screen right now.
But Bank of America goods are going to be more expensive. There's no guessing. Imported goods are more expensive. That is a fact. Yes. Imported goods are part of domestic goods. To Ilya's point, an American car is full of foreign goods. All the things. So basically, the cost of everything, whether it's foreign or domestic, has been increased. Whatever the CPI says, whatever PPI says, mathematically, there has been a 15% plus or minus, depending on the thing, increase in the cost of things. Now, maybe in some cases it's 5% because of the pass-through and it's not all foreign and blah, blah, blah. In other cases, it's whatever. So I think arguing about the price increase is silly. I think the question is what is the tolerance for the price increase?
Right.
And the market is
there seems to be high tolerance.
That the tolerance is high.
Well, that's one of the charts I have up on the screen here. Bank of America put out this chart showing total credit card and debit card spending growth per household based on their own credit card data. So it's not not the economy, but it's a big sample size. They see 0.
number.
No, and they see 0.6% month over month growth in July, accelerating after the increase in June. And both April and May obviously were bad. But maybe we're still in the revenge spending, Ilya, in terms of the data set. I know it's the middle of August now, and people's spending habits in August may have evolved. But July looks like it could still be a decent enough number. And so just like you had with CPI, if it's good enough that doesn't scream imminent recession, it's hard for me to get worked up about it for tomorrow. And I also point to this other chart. I mean, we're not even in a place right now where the treasury markets, given the treasury spreads, are thinking that recession is feasible here. 28.947% implied chance given the 3-month 10-year spread right now. Mm-hmm. That's well below where we were throughout 23, 24, even earlier this year. Ilya. Now, that's not to say this is a perfect indicator, but we've never had a recession when the indicator has been below 0.4. Ever. So keep powering on. That's the market's bet here right now, that the market will keep powering on. And the people who are playing in the market, the upper income consumers, as Bostic said yesterday, They're holding
Which
up.
brings us to the Russell and the conversation we were just having. Why the Russell? Because if you are going to have a relatively high tolerance for this inflation, or you're going to look through it, you're not going to have a recession conversation near term. Well, then what you have in a lot of these indexes is a break past their preceding high, and today a pullback to retest it. But whereas in the S&P and the NASDAQ, you have to buy something essentially a hair away from all-time highs, that is not the case in the Russell. In the Russell, you have a little bit more headroom. Risk-reward is a little bit better. So if you are going to be a buyer of stocks here, and I was absolutely circling around this today, just looking for a level that was attractive to buy vol at. It ultimately didn't happen, but maybe I'll get a better shot tomorrow. We'll see. But I was absolutely looking on the long side of the Russell today, because the high there was back November of last year. So we're talking almost 2,500 on the Russell. You're well short of that here. So there's a little bit more room. So do I think that the economy is in good shape? No, obviously not. But in the spirit of trading the price action, this was a nice little discount on Russell today. So I'm going to be watching this carefully tomorrow. The pricing, as I say, didn't really afford me risk reward that I thought was attractive enough. It was maybe like 1-to-1, 1.2-to-1. That seems like a silly bet before critical retail sales and other data is going to give us the next major inflection point in this story. So we'll see tomorrow. Maybe vol will get a little bit cheaper. Maybe the setup will get a little bit better. Maybe we'll get a little bit of a washout.
What's fascinating for me, Ilya, is the market's apparent perception of the consumer's tolerance for higher prices.
Yes. Moreover, the market seems to have forgotten why it wants these rate cuts. We had a big conversation about this on Macro Money yesterday, and of course we mentioned it on Overtime as well. The market is clearly more dovish than the Fed. The market still has 125 basis points between now and the end of next year. That's 50 basis points more than the Fed is forecasting. So the market is very clearly saying there is a bigger downturn in growth than the Fed appreciates that it needs to be acting against, while at the same time saying, but that doesn't matter for earnings, consumers, and the economy, which is incredible cognitive dissonance.
I mean, Ilya, I think we just got to go to the earnings themselves.
As it presents itself.
I mean, who is eating these costs ultimately? If we're to believe the data and believe the earnings numbers.
At this point, it's consumers.
The blend, and this is how you get to that conclusion. According to FactSet, the blended net profit margin for the S&P 500 for Q2 25 is 12.8%, which is above the previous quarter's net profit margin of 12.7%, above the year ago net profit margin of 12.2%, and above the 5-year average of 11.8%. So if profit margins are staying intact and wholesale prices are rising, who is paying the difference?
The problem with that argument for stock markets, and I want to give full credit to Bloomberg, they ran a big story about this today. You look at the spread between CPI and PPI, and right now it's very clear that consumers have not been eating it because the spread is negative. That is, CPI is lower than PPI. As the pass-through happens, that's going to change. And what's going to happen then is the problem
do you think the market
that you don't want to see for stock markets.
What I don't understand is that is hardly a secret.
You're right.
And this is the cognitive dissonance in the whole thing.
I mean, the market is a discounting machine. The market knows what you just said is a fact, and they're okay with the current price levels.
Is it possible
this is where the rate cuts? Sorry?
Isn't that the 40 chess here? Like the tariffs are going to push up inflation. It's going to lead to a negative downturn. Trump's going to have to scale them back in some form or fashion.
And the Fed's going to cut rates.
So the Fed's so the tariffs are going to come off at some point, and then the Fed's going to be cutting rates.
You're assuming a lot for which
that's what the market's assuming, right?
But that's of course there's no evidence.
I don't think you can impute that at all. I don't think there is any way to know that the elephants will fly outside our window in 5 years. Like, who can know these?
How do you justify
I've seen the movie Dumbo
level?
And this is where some of us look at this and go, the market's level is not reflective of optimism about the economy, as break-even rates in the bond market would readily show you. The market's level is about a positive sentiment shift around the idea that having threatened to crash 40 years of a U.S. post-war financial system that has given the U.S. virtually everything it's ever wanted financially on a platter, the U.S. is going to stupidly destroy that order.
So
and then in April, the U.S. decided, no, actually, we're not.
Does that not then make us hand over fist dollar buyers for the second half of this year?
I'm a hand over fist dollar buyer.
Mm-hmm. Hand over fist dollar buyer.
Take your logic, like if the whole thing is okay, Trump is not going to disengage 40 years of financial infrastructure.
Yes,
which is why the dollar.
I think that's what the stocks rally is all about.
Mm-hmm. Hey, what's the most hated trade on the board still, according to the Bank of America Fund Manager Survey? The U.S. dollar.
Fantastic. Beautiful.
You're saying long dollar is the least popular trade according to BofA?
Short dollar is the most popular. Long dollar is the least popular. Yeah.
Excellent.
I mean, that's nice. That's almost a confirmation, I suppose.
That's excellent.
To our little.
I love it.
Hypothesis.
I love it.
It's a crowded trade, and listen, there is a. Well, forget the rate cuts for a quick second, right? The story
and
coming
the dollar
into July,
has stopped falling, by the way, despite the fact that the rate cut bets have grown.
So that's the story here. The story is since July, rate cut bets have grown, and I think this is one of those. In hindsight, we talk about positioning being so important and it being a crowded trade.
Yeah.
Even though the rate cut odds have gone up, has the dollar been able to keep falling? Everyone who wanted to sell is sold. It's difficult to keep it going down. And the series right now of higher highs and higher lows remains, Ilya, off the bottom here. That's not a break yet.
Nope. I'm still.
It's not a break yet.
I mean, do you have a preference? Dollar, euro, dollar, Canadian, dollar.
I have a basket on. I have a basket
Canadian,
on.
Euro.
I'm long the dollar against euro, pound, yen, Canadian dollar, Aussie, Swiss franc, across the board.
I personally like the Canadian dollar. It did not jump significantly.
That's been one of the better ones. That and the franc, to Chris's point.
Yeah, but the Canadian dollar didn't rebound substantially when the dollar was coming off again here in August.
Yeah,
it ran into its monthly moving average, its 50-day moving average, swing lows that we had in June and July, and had started to turn lower again. Mm-hmm. So it's not exactly a situation where it looked like it was a source of strength. The yen, on the other hand, down by 0.27% today. Look at that beautiful test of that 50-day moving average. Kissed it, turned lower.
We hold it.
This is exactly what you want to see. The volatility is not exactly there if I'm looking at a 16.7 IVR in the end to look to sell calls, but in the euro, you're still north of 46.
Yep.
46 in the biggest, most liquid currency future. That's all you can ask for.
Yeah. No, in my mind, the most interesting thing on the board here that affords you the luxury of not having to worry about what the stock market is smoking here is to look at the dollar and go, you know what? Either we're going to get these rate cuts or we're not. but the dollar has stopped responding to the near-term speculation. So either the dollar is going to rally because this whole thing is a giant growth risk, and you're going to get a dollar back to haven mode, because now that you've decided you're not going to crash 40 years of a U.S. financial system, the dollar is back to being the cash of last resort in a risk-off scenario. Or the Fed is going to dither and you get a yield kick. And then the dollar rallies for those reasons. For whatever reason, the dollar is no longer interested in the idea that the Fed is going to cut by 50 basis points this year, which is what the markets are pricing. It's what the Fed has been saying since December of last year. That expectation is baked in firmly at this point.
Dylan, let's switch topics here and talk a little bit of corporate news that came out here after hours. What's Warren Buffett's favorite expression about buying stocks, Ilya?
Which one?
When people are panicking, something in the street?
Oh yeah, when there's blood in the streets by property, sure.
UNH is now
You're part of full Luigi on me now.
I didn't say it. Ilya talked about blood in the streets when I brought up UNH. I did not do that.
We're quoting.
You set him up, sir. You set him up.
I did no such thing.
We're quoting the Oracle here. Let's just be clear.
Warren Buffett
but also,
is now,
if ever there was an assessment of contrarian investing in a phrase,
I mean, is UNH basically binary now? Either it will continue to exist, and this is the greatest entry point in the history of mankind, or it has to go bankrupt.
Well, Buffett made that decision today. UNH is up 8.14% here after hours, after Warren Buffett reveals he purchased 5 million shares of UNH. Incredibly steep discount. This is probably the go signal. If Uncle Warren's in Ilya, Dylan, right? I mean, this is now going to bring in a whole host of people and followers. And
stop thinking. No thinking. This is a no thinker.
No thinker.
The risk reward isn't tempting for me yet, because we're basically near the top of the recent range. When Uncle Warren does things, let's remember he never ever sells, but for very, 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 very special reasons. And his timeline is measured in decades. So that his decisions and our decisions in a 45 DTE world are very different decisions.
Yeah, but a lot of traders who jump in and don't think for themselves, which we could be those people, Dylan, right? We don't need to think for ourselves here. But there's a lot of people in this world who follow Warren Buffett into whatever he does.
Right.
No matter what.
Sure.
So this
thinking
probably is going to get a pop here.
Ill-advised at this juncture.
Well, and this is why I think what you want. That's why you need good risk reward. You're at the underside of the previous range.
Let's call up the screen. Let's figure this one out. What are we doing, Vecchio? Fire up the panels. What are we doing?
Thinking about right now, the stock's trading at $29.25. It closed at $27.61. So if we wanted to think about the close prices, okay, something like a short put spread at 250-260. The short strike about $10 away from the close, the long strike $20 away from the close would have yielded in the neighborhood of about a 2-to-1 risk to reward. Sliding that up another $20 to account for the change in share prices here, you're probably looking at a 270-280 short put spread. Then we have to see where the market goes tomorrow when it opens, but anything in the neighborhood of a 60 to 70% probability of profit, 3-to-1 risk to reward or better.
Spread over any other mechanism at this point.
Yeah, that the stock's done falling. The lows for today come in around 266, 267. So effectively, the bet would be that this is the Buffett bottom for United Healthcare.
Well, and if you can get a run from, let's say, 300, which is that little congestion range middle from mid-May until the next leg of the sell-off mid-July, if you could get a run from there up into like 425, 440, the underside of the range that prevailed from 2021 to 2025, that's good enough. I just want to see a little bit of confirmation here because, again, we're at resistance, directly at it. So the risk reward here isn't great. Either you get a little bit of weakness tomorrow to reset, or you get a break higher. Either way, I mean, the market's obviously closed. So whatever you're doing tomorrow. But,
yeah.
But if you get a little bit of a reset on risk reward, the architecture is there. It's got to do that thing, though.
UNH to me listen, UNH has so much risk because of all the lawsuits.
Tons.
There's probably better plays out there for longer term trading to the upside. What company am I thinking of here? Is it CI? Yeah. Cigna, for example. Cigna doesn't have all of that baggage that a United Healthcare does, and there's still more lawsuits coming. So if I was thinking about being constructive on the space longer term, I'd probably like a Cigna more than a UNH. But the Buffett bottom to me is a compelling enough point where today's low, the recent swing lows that we've seen, probably will hold in the short term. If you wanted to get out, you've probably been getting out over the past few weeks and months. So I don't know if there's a significant long trade there, but if there's vol on the board, 27.9, if it's persisting tomorrow, we have a level to trade around 260, 270. Mm-hmm. And that's a potential. That's just a potential idea to kick out higher volatility than what we're seeing in the equity indexes.
Yes.
I know what I'll be doing. Dylan, I do want to get your opinion here because it's the last show of the week. It's the Thursday here. There's so much going on in the world, but surely we need to be talking about this Alaska meeting between Trump and Putin. I couldn't help but notice today that oil prices rise as some of the headlines about this meeting are coming out, and the corresponding move is for the poly market, betting markets, to reduce odds that there would be any sort of ceasefire arrangement reached when Putin and Trump meet. Do you think that this is how do you think this is going to play out and how do you think it impacts oil?
I believe Russia exists. Forget Russia. I believe Putin, president of Russia, exists in a psychological state where he is utterly indifferent, where no one, in his mind, no one, not Europe, not Ukraine, not the United States, no one has any leverage on him at all.
Yeah.
And so and this is a very, Ilya can speak to this, but allow me to do my best version of being a Russian interpreter of culture. No culture in the world is more notable for its tolerance for suffering and its indifference to outside leverage. And so I agree with the rise in oil prices. I agree with the poly market discounting. I believe that Putin has zero. If the Ukraine war will end, whatever that means, when Putin wants it to end on the terms that he wants it to end on. And there's nothing that the United States or Europe or Ukraine will ever be able to do about it. That's what I believe. This is an ice-cold
very,
situation.
very strong argument in favor of that perspective. I think Dylan's absolutely right on the money as far as the Russian population's willingness to take it on the chin and just expect the Tsar not to care and to do what the Tsar does.
And life is good in Moscow, by all accounts, by the way. No problem. Cafes, the country's doing...
It's good in Moscow. It's probably decent in St. Petersburg. It's probably awful otherwise, but...
No, well, yeah, the graveyards
but is it more awful than people are kind
irrelevant.
Of... Right, like... Awful, yeah, but...
No, I was in Lithuania a couple of weeks ago in Lithuania.
The Russian mindset usually is things may be awful, but it's our awful.
Well,
and nobody's gonna tell us that our awful isn't what we want.
And there's no number of tombstones for 20-year-old men that's going to change anything. I mean, I was in Lithuania a few weeks ago, which is 20 miles off the Russian border of Kaliningrad.
Yeah.
And it is a widely known fact that the number of grave sites of young men has exploded over the last few years. So it's sure. The point is not that this is a human catastrophe or that Putin is ultimately a mass murderer, in my opinion, of his own people and others. Mass murderer. It's that the political tolerance for it is unique. No country historically, I mean, look at World War II. It's a point of pride. There is no country in the world that is more tolerant of killing its young men than Russia. And that's what makes them indifferent to leverage between nuclear weapons and the history of basically unlimited tolerance for death of their young men. They're going to do whatever they want.
I mean,
another way and Trump is a sucker for him at the end of the day because Trump wants to be perceived as an equal. And this is Putin's dance, and everybody else is just in the room.
I like this breakdown. It's very talk show radio. This is very talk show radio.
Yeah, I mean, another way to look at it is just to say that for him, you ride this thing until the wheels fall off because either your gambit ultimately pays out because the other side is desperate for peace, or, and by the other side, I mean, of course, Europe, the US, Ukraine, everybody. Everybody wants really badly for Russia to stop, which gives Russia the cards and the leverage. And Russia, at least in the president's visage, is of the mind that, look, either I'm going to get eaten internally or I'm going to win this thing. Screw it. Run it up. We've come this far. Let's see how far I can push this thing. Maybe I can still make it on the other side.
And now I have the American president in the room with me, so the alienation is declining. I'm no longer ostracized. So now I'm doing this iron squeeze in Ukraine, and the ability to isolate me is in decay. I'm getting stronger.
And Trump is out here attacking Europe today for buying Russian oil from India.
Right. Only issue here is every now and again, if you look at Russian history, every now and again, the population says enough is enough. And there is, sometimes out of nowhere, a complete hard reset. Now, the problem with this, of course, is there can never be any evidence of it because everybody is too afraid to say what they think until the whole thing hits the fan.
Well, it's illegal to use the word war in Russia.
Right. So the edge case, and there's no evidence for this being imminent or anything like this, but the edge case here is revolution.
Well, yeah, I mean, it's pretty clear from the public reporting that Putin sees the war as necessary for his regime's survival. If he loses the war, then the regime falls.
And by the way, we don't just mean the Bolshevik revolution. We don't just mean the revolution against the Tsar. I mean, Yeltsin, the early 90s, the collapse of the Soviet Union. I mean, that's also a revolution. That's a recent revolution. It's not followed by civil war as the Bolshevik revolution ultimately was. But we're looking here at the only way this resolves in a way where Putin doesn't get everything he wants is he gets to a pain threshold that is so great that the population finally says, you know what, let's just burn this thing to the ground.
All right, so we get to oil here. You're getting a bounce back. If we have a bounce back to where we were prior to whatever kerfuffle this was at the end of July, probably 64, 65. Is this still a place to continue to trade sideways in oil? I think so. I'm doing it. It works. Not the sexiest trade, but still risking 3 to make 1, 60% plus pop. Dylan, we talked about this earlier this week. Consider it a missed opportunity, perhaps, but Intel up 7.38% today as the U.S. is considering weighing an investment following the CEO's visit to the White House. We talked about this earlier this week. Is this the best strategy that we can put in our pocket as a flyer right now to close the loop on it? Should we just be looking for headlines about what CEOs are going to the White House?
It doesn't. It certainly falls into the no thinking opportunity zone. I've heard worse ideas. I mean, the best idea is to buy UNH on Buffett. You know, I would say it's a distant second to buy the CEO meeting, but buying the CEO meeting is not a terrible idea. But I also think that actually the Putin-Trump summit could be a reason to buy oil.
You have the final word. Tell us before the show ends.
Me or Ilya?
You. Yeah, you.
Go.
The final word is very simple. This Russia thing is a boondoggle. It plays to Putin's benefit, and oil should actually get higher, not lower, because I think what you're going to see coming out of Alaska is a calcification of the fact that no one can do anything to stop Russia, and that all hope for any intervention from Ukraine, Europe, or the United States will be lost after this meeting.
With that, overtime's out of time. We'll be back same time next Monday, here every Monday through Thursday on Tasty Live, right after last call, 4 p.m. Eastern, 3 Central. So for Ilya Spivak in San Francisco, Dylan Radigan on the run, I've been Chris Vecchio in New York. Good luck trading. After this, more Tasty Live coming at you. See you at Macro Money.
See you there, everybody.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from tastytrade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. tastytrade. Download today.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to tastytrade. So spread the word and earn rewards. Terms and conditions apply.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
What's one macro risk that people aren't talking about enough right now?
I think we kind of saw it with the tariff sell-off. There's just huge concentration in Mag 7 stocks, all the big tech names. If something happens with those products, you're going to see a massive move to the downside. So I think if you're in products if you're in ETFs that are highly concentrated around a handful of names, and that could be a number of different ETFs. It's always important to check the actual makeup of the ETF you're trading. If you're looking for that kind of concentration, that's fine. But if you're looking for more balance, I would just double check that you're not in one that's super concentrated.
You know, that's a hard question. My answer to something like that is always the unknown. I don't necessarily think that most of the stuff that we pay attention to is stuff that's going to explode the way that we think it is half the time. A lot of it I feel like is kind of unfounded worries. So I don't know if it's a cop-out answer, but I'm just going to say whatever it is, we're not talking about it right now.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11. Sign up today at tastylive.com/events.
We're going to go to New Orleans. I got to be in New Orleans. What's up?
Y'all three guys, just the whole organization is just phenomenal, and it's changed my life. And I wish more people would just sit back and listen to y'all and take it seriously, because it will change your life if you enjoy trading. I don't know if I could ever repay any of y'all for this free advice and free teaching y'all do. Is just remarkable. Tom, I got your hat on, and ever since I got it on, I've been blowing the market up. So make sure you don't give one to Tony or Scott, because I don't want them to benefit from us.
That's okay. Good job out of you.
My dad, who was trading options in retirement, introduced me to options trading. He said, you have to check out this tastylive site. The way they taught options was very accessible and easy to pick up. I think a lot of people think that options trading is gambling, but it's not. It is simply probability and taking an educated guess. It's more like insurance. People should watch tastylive because you can pick up a lot of information in a short amount of time, and it's actually practical. You can use it to make money, most important part.
Calling all traders. Are you using tastylive mechanics and enjoying awesome results? Are you an up-and-coming options savant? We're looking for you. For over a decade, tastylive has shared the most inspiring stories of traders teaching themselves a new skill, using probabilities, and experiencing new levels of success. If you think your trading journey should be shared with Tasty Nation, we'd love to hear from you. We are always on the lookout for the next class of rising stars. Email us at risingstars@tastylive.com if you would like the chance to share your trading journey and inspire others.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
Tariff inflation is here. That's the message we get that gets the dollar going and, at least temporarily, spooks the stock market today. Will consumers get discouraged? That's what we're going to try to unpack here, because, as ever, that is the biggest question for this U.S. economy and ultimately then the markets. I'm Ilias Spivak, head of Global Macro here at Tasty Live. This is Macro Money. And we're going to take a look at what the markets did with today's data offering, potent though it was, and consider what all of this means as we start to look at what consumers might do with this and why that's so important when we get retail sales and consumer confidence numbers here in less than 24 hours. So let's break this down. The market today, a little bit soggy, but only a little. S&P 500 down 0.07%. NASDAQ down a little bit more, 0.28%. Hardly major changes here after yesterday's big moves and, frankly, big moves earlier in the week. That CPI report we got this week still largely intact for its influence to the upside on these markets. Probably the biggest swing, which we don't have on the chart here, was the Russell down 1.28%. That's after a rally of almost 2%, 1.96 yesterday, and a blistering almost 3% rally on that US CPI report the day before. So we have a little bit of a cooling off rather than some sort of a capitulation in stock markets today. Notably, yields go up. 10-year up 1.25%, 2-year up 1.44%. Crude oil is up for its own reasons. Again, it would seem it's really been moving around a familiar range here for its own reasons. We, of course, have that summit between U.S. President Trump and Russian President Vladimir Putin in Alaska coming up. So maybe that's something to do with that. But oil has been really pinned to this central axis around 62.20, 63.40. That's been a sort of center line for the broader 54, let's say, to 73 range, going all the way back to September of last year. So yes, we get a little bit of a pop, but do we ultimately get anywhere from that center axis? Not really. In line with the move in yields, in line with the move in stocks. Gold down a little bit here, 0.8% almost. Euro down, yen down. That, of course, speaks to a stronger US dollar. And Bitcoin off 4.09%. Again, not the craziest change in sentiment here for Bitcoin. I mean, certainly it's a notable thing that it has swung as it has, and indeed it's erased 3 days of gains today. It's essentially back to where we were last Friday, but nevertheless, we're still sort of in this broader 123,600 to 113,000, let's say, range that's persisted since mid-July. So notable swing, certainly, but again, not anything that appears game-changing per se. But certainly the tone here was weaker risk, higher yields, stronger dollar. And that sort of comports with what we're seeing in Fed policy odds. Note here, we're still very much on track for a September rate cut, 92.8% probability in Fed funds futures. But whereas yesterday there was about a 6-7% chance that it'd be a 50 basis point cut, not 25, today it's a 7% chance that there is no cut. So we're getting fuzz at the margins here. And whereas yesterday the fuzz was in favor of a more dovish perspective, today the fuzz is in favor of a slightly less dovish perspective. But the central thesis remains September is probably going to be a rate cut. But the markets clearly saw some data today that swung them from erring dovish to erring less dovish. The outlook on the path forward here overall, now firmly 50 basis points for this year. That's exactly in line with the Fed's own forecasting from the June summary of economic projections. That's the last time this was updated. 50 basis points here from 4.4 to 3.9. But then the disparity continues for next year. The Fed sees only 25 basis points here. The markets are discounting clearly a lot more. They're fully priced here, it would seem, for 3 cuts next year, give or take a few basis points. So the architecture of what happened here yesterday into today is broadly holding. But the markets clearly caught a little bit of indigestion, and they caught it because wholesale inflation numbers, incidentally, as we suspected earlier in the week, and as we talked about the CPI report, suggested that that CPI report in its benign visage is smoke and mirrors to a significant extent. And that, of course, came from PPI data. So here we have it. This is the month-on-month increase in wholesale inflation. We can see with the naked eye here that this is a dramatic month-on-month surge in wholesale inflation, 0.9%. By the way, it's the same number for headline and core. So this is exactly the kind of wholesale inflation that you cannot write off by saying, well, food prices, energy prices, the Fed doesn't care about those. That's something that they don't have agency over. This is not going to make or break policy. No, this is core as much as it is headline. This is an eye-catching jump by any stretch. And we can see here that the reference point for this goes back, obviously, significantly to this reflationary surge that we saw through COVID. This is ultimately what the Fed moves to act on with those rate hikes in 2022. So here is the middle of 2021 where the Fed kind of starts to recognize they have to make a move. And of course, this is where the hiking cycle kicks off. So we're back to essentially a 3-year high here for the last time we've seen comparable jumps. Here's the year-on-year reading. At this point, we're back to February for overall wholesale inflation, but the violence of the jump is clearly on display here. If this was something like what looked normal through the markets digesting the onset of tariffs, well, we're not digesting them anymore. They're starting to appear, and they're starting to show up in wholesale inflation. Most importantly, I would argue, if we look at how this has worked up to this point, we've seen that wholesalers have eaten extra tariff costs by basically saying, we're just going to make less money. We're just going to take it in margins. And we're going to accept lower margins on our business because what we're going to do is we're going to eat these tariff costs. And the reason why we're going to eat them is we don't know what's going on with this tariff regime. Things are changing very quickly. We're not going to pass on higher costs to consumers, get those consumers to stop buying stuff, and then the landscape changes and it turns out we've destroyed our own demand for no good reason. So since the beginning of the year here, we can see even at the final demand stage of wholesale inflation, this trade services component, that's wholesalers' margins. And we can see here that in this latest data, those margins shoot up aggressively. Back to January 2022 is where we have to go to see something comparable. And of course, what that means is rather than eating inflation and letting it bring down margins, it is being passed on and those margins are expanding. So wholesalers are passing on tariff inflation. Most importantly, where this holdover, this insulating of consumers was most pronounced was even earlier in the supply chain. We can see here, this is final demand for PPI. This is PPI intermediate demand. So this is the very, very beginning of the supply chain. This is where the tariff cost is initially felt. And we saw back in April when we sort of hit maximum holy moly on concerns about tariffs, they end up taking a hit of over 2% in a given month on margins, which is a huge hit, a recession-like hit, where wholesalers say, we are not going to pass on these costs. Well, they've started to pass them on. We get this jump here in excess of 1%, even at the intermediate level. And this ends up being the biggest jump at this stage of the supply chain since the middle of 2023. So we're talking a 2-year comparative reference point. Now, obviously, there's fuzz here as we get initial kind of fuzz around the tariff implementation. But if we kind of take ourselves outside of 2025 and consider what is a reference point for this historically, this is where we're looking. Now, when you get this kind of a thing, when you get wholesalers eating the inflation at the start of the supply chain, what you end up with is the kind of CPI numbers that we've just seen, where most inflation is still in services. This is where the markets go, oh, well, this is so refreshingly normal, 2.7%. Okay, so we get a little bit of a bump, but this is not anything crazy. And in any case, the goods side of the inflation story is still relatively modest, even though it's perking up. Or so it would seem, because again, most of inflation is still living in services. But what we see from the thrust of the change here, where inflation is dynamically moving higher versus not, in services, it actually comes down in terms of its contribution in July, but in goods, it's clearly going up, so much so that we can see here the thrust in goods for a second consecutive month is almost a tenth of a percentage point, whereas in services, it's actually going the other way. And as we saw earlier in the week when we unpacked this a little bit, core goods inflation went up month on month in July. Core services inflation went down. The rate of core goods inflation is the highest in 2 years at this point. This is our reference point back here, sort of mid-2023. Services inflation is also going up, but much more so within its range. The reference point here, December of last year. So what we're looking at is indeed evidence that suggests that we have tariff inflation now heading in the direction of consumers. And of course, where this becomes particularly worrying is when we look at these GDP numbers for the second quarter, what we see is, on the one hand, the other force keeping inflation at bay for consumers. We can see in the first quarter here a giant front run of imports. And again, this is contribution to GDP, and imports are subtracted from GDP. The component from the external sector in GDP is exports minus imports. And so the surge in imports here looks like a decline because this is a detraction from GDP that imports are surging. We can then see in the second quarter, imports are an addition to GDP because they're cratering. By the same logic, we can see here in the first quarter, inventories, which are a part of the investment component here, they surge because obviously all these imports have to go somewhere, and they're not going to feed current consumption. They're going to stack warehouses full of goods at pre-tariff costs. We can see that in the second quarter, those inventories are falling. That is, those goods are being spent. They're being sold out of inventory. So rather than companies buying goods that are now including of tariff costs, they are being sold out of inventory, but of course imports have cratered, so those inventories are not being refilled. So not only are wholesalers now passing on inflation costs, as the PPI data here suggests, but we are now seeing the other source of defense for consumers, this inventory buildup in the first quarter, that's falling away because those inventories aren't being rebuilt and the stock that's in them at the lower cost is being depleted. All of this, of course, comes together to tell us a story about how consumers are going to start to really feel these tariff costs. And what we already have in this GDP data, as we've said time and again here, is the contribution to GDP from consumption, which is by far its largest component, 68% of GDP. This contribution is already the smallest in the first 6 months of this year since the first 6 months of 2020. That, of course, is the COVID recession quarters. So consumption is already weak, and now we have this pass-through of inflation to consumers, not only because this front run is running out of room, but also because clearly wholesalers have started to make their move. You can see that here. This, of course, makes for very interesting watching as we get retail sales numbers coming out here to finish the week in macro event risk. 0.5% rise expected month on month after a 0.6% rise in the prior month. We're also going to get consumer confidence numbers. The expectation is that we're going to hold relatively steady on the current conditions index. Maybe we'll even get a little bit of a slide up on the sentiment side of things, but expectations expected to dip. And of course, not only are we going to be watching very closely what happens with the interplay between these numbers, but also with the one-year inflation forecast, which we can see here has been a critical driver of consumer sentiment. Indeed, since we saw the peak in inflation concerns going into the Fed's rate hike cycle, this is when they finally say, you know what, it's time for us to get a move on. This peaks as sentiment bottoms because, of course, the Fed starts doing the hikes that they so aggressively delivered in 75 basis point increments. And so inflation expectations start falling, consumer sentiment improves. Then we get to the tariffs. Sentiment craters as consumers start to say, well, the tariffs are going to be very inflationary. So we get this jump in one-year inflation expectations from 2.6 to 6.6 at its worst. But we've now cooled back down to 4.5 as of June's numbers. We'll see if we get further cooling here into the August numbers. But if in fact consumption is already weak as of the end of June, the second quarter GDP numbers, and we can see that in July, costs are already starting to feed from wholesale inflation and into headline, then the expectation would be, perhaps, amongst consumers that inflation is actually going to be higher going forward, not lower. And if this starts to tick back up, well, then that's bad news for sentiment. So the threat here facing markets is that, in fact, what we are on course for is another weak consumption quarter in the third quarter. And this is the ingredients from which recessions are made because, of course, we have an economy that's overwhelmingly consumption. Now, from the perspective of the markets do not want to see recession-flavored data. In fact, we saw that in spades with the jobs report, that's this wiggle lower here, which was, of course, very disappointing. And we see this rebound because what that ultimately gives us is a more dovish outlook on the Fed. But as these numbers go, if we get very strong numbers, well, then the outlook on the Fed can't get very much more dovish. If we get numbers that are relatively close to expectations, then chances are the probability of a September cut remains broadly intact. If we get very weak numbers, like we did with the jobs report, ostensibly the markets become more concerned with growth than they are with rate cuts, as the jobs report pointedly showed us. And then stocks don't like that either. So the middling outcome, the middle of the distribution outcome for both retail sales and sentiment is ostensibly what the markets are after here. But perhaps even more interesting than stocks is the US dollar, which has been carving out a bottom At the very least, it has stopped falling after this precipitous decline in the first 6 months of the year, even as you get this most recent dovish shift in expectations. And so whatever happens tomorrow, perhaps one of the more interesting trades on the board is either you get a safe haven dollar that rallies because the markets don't like retail sales numbers, or the retail sales numbers are strong. Stocks are left scratching their head as to whether they like the earnings part or the less dovish implications for the Fed. But with those less dovish implications, you get a stronger dollar, much as you saw today. So if stocks are perhaps a little bit fuzzy, the US dollar, in its resilience since the beginning of July, seems to be telling a story. We'll see what that story means for stocks, but for the dollar, it might mean an interesting trend change opportunity that is just beginning to ripen. And that is macro money for today. As ever, we are here Monday through Thursday, right after Overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm back with Chris for Futures Power Hour Mondays and Fridays, writing for the News and Insights portion of tastylive.com, commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money is back next week. Happy trading.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
The future of trading is here. Join Mike and his whiteboard, plus the Tasty 2 live crew for 90 minutes of probabilities, punchy portfolio mechanics, and trade tactics. It's totally free and unreasonably fun. Come early to enjoy a drink with the crew and stay for a Q&A after the show. Space is limited, so register today at tastylive.com/events.
What's one macro risk that people aren't talking about enough right now?
I think we kind of saw it with the tariff sell-off. There's just huge concentration in Mag 7 stocks, all the big tech names. If something happens with those products, you're going to see a massive move to the downside. So I think if you're in products that are, if you're in ETFs that are highly concentrated around a handful of names, and that could be a number of different ETFs. It's always important to check the actual makeup of the ETF you're trading. If you're looking for that kind of concentration, that's fine. But if you're looking for more balance, I would just double check that you're not in one that's super concentrated.
You know, that's a hard question. My answer to something like that is always the unknown. I don't necessarily think that most of the stuff that we pay attention to is stuff that's going to explode the way that we think it is half the time. A lot of it I feel like is kind of unfounded worries. So I don't know, it's a cop-out answer, but I'm just going to say whatever it is, we're not talking about it right now.
Traders, start your platform. Tom Sosnoff and Tony Batista are hitting the road for their first ever live trading event, At Work by 11. It's unprecedented, unpredictable, and unlike any other financial event. Watch these masters make real trades in real time. Doors open at 8, the action starts at 9, and we'll have you back at work by 11.
Ready to take your trading skills to the next level? Dive into the world of stocks, options, and futures with Tasty Trade courses. Whether you're a beginner or more advanced trader, our courses can empower you with the knowledge to succeed. Watch as our team in Chicago shows you how to use the Tasty Trade platform and go over the basics of trading. Perhaps you'll learn about a new strategy or a potential product for your portfolio. To find our courses, go to the Manage section of our web platform or head to courses.tastytrade.com. Start taking control of your financial future. Visit our courses today.
What is going on, everybody, and welcome back to Risk and Reward with Gus and E. Today is Thursday. We got one more day of the week. We also had the open house today. That was a pretty good time, wasn't it, Gus?
Yeah, it was awesome. Getting to meet everybody and finally put some faces to the names that we're seeing in chat all the time. Yeah, it was excellent. We have our live event in Chicago tomorrow, which I am getting up bright and early for. Let me tell you. And yeah, looking forward to that. It's a fun week, a little bit chaotic week, but you know we like to bring the chaos here. The fun comes with it.
Exactly. You thrive in a little bit of chaos. It makes things a little interesting sometimes, but no, it was a really good time today. Really nice to walk around, meet everybody, and really just game plan for tomorrow. I haven't actually been physically to the live show, so I'm actually really looking.
Yeah, this will be my first one as well. I've done lots of the pre-recorded stuff that we shoot over at Live Bash and all that good stuff. But I've never been to one of these live events before. Man, I've only been here 6 months, so yeah.
Looking forward to it.
It's going to be exciting. Yeah, I'm not looking forward to that alarm tomorrow morning though.
No, you're already thinking about it, right?
Bro, I got to be there at 6:45.
So what? That means you got to be there 6:40. So you got to wake what?
5:45, 6. Something like that. Yeah.
Things are prepped the night before.
Yeah.
Cool.
Yes.
Yeah.
But it's gonna be a fun time. I'm looking forward to it. I'll tell you what too. I just before we started, I got a notification from DraftKings. Okay. They say they have a pick for the Diamondbacks Rockies game tonight. Guys, PSA: if your sportsbook ever tells you should take a bet, run the other direction, please. Okay, that's all I got on that.
I hear you completely. Again, Colorado Rockies. I'm a Colorado guy. I got to put my input.
Boy, are they terrible.
Bro, I could as I'm lining that up, I'm like, they didn't give me much to work with here. I haven't really been watching the Rockies since the Matt Holliday days. I don't know if anybody remembers. Shout out to Matt Holliday. But anyways, as we get into the segment for today, UNH, that's always been the talk of the town the last few weeks, especially with Luigi, the shooting with the CEO. We'll give a quick update and a rundown on all of that. But we had some pretty big moves in the after hours. What happened in UNH, Gus?
Yes, Berkshire Hathaway has announced that they have put their hands on some UNH, $1.6 billion of UNH to be exact. They are essentially just buying a large dip. And let me tell you what, I beat Berkshire Hathaway to this sentiment. I bought before they did. They disclosed that they added this position at the end of June. And Errol, what a luxury it must be to be a Berkshire Hathaway, a Warren Buffett, a Peter Thiel, and just be able to say, hey, by the way, guys, I bought this, and then it is immediately.
It just goes up.
Yeah, you just are right. Yeah. You are right just by telling people that you did it.
And you know what's funny? I mean, Warren Buffett and some of these guys have really solidified their name in headlines and just getting buzz, because I think about Elon Musk, seeing those tweets, seeing what Elon eats for lunch, seeing that move the market was so profound to me. I thought it was insane that an individual could affect the overall market or his specific stock, especially because it's such a massive underlying. But Warren Buffett isn't somebody that tries to stay relevant. He's not right.
And he's left Berkshire Hathaway.
Exactly.
Yes.
If anything, he's trying to really go into the shadows, and we're still seeing these names in these headlines. I don't know. What are we still trying to milk these headlines while he's still around and relevant? Whatever the case might be.
No, I'll tell you what. As somebody who just moments ago wrote Warren Buffett's Berkshire Hathaway on this slide, I am absolutely trying to milk these headlines. Yes, it's what you must do.
Like, at me, bro.
You got to play the game.
Yeah, but the fact that we still think about Warren Buffett and by him making a big purchase, it's still a big deal to us, right? Elon Musk is on Twitter. He owns Twitter. Elon Musk is a little bit of a character, so it's not a surprise he's able to develop and continue to grow his personal brand, because it's Elon at this point. Obviously, he's going to have the confidence to do it, because when you're the wealthiest man in the world, you're going to go out there and probably say whatever you want to whoever you want, however you want. But again, Warren Buffett is in the shadows, and his name's a massive deal, especially for whatever he's putting his money towards.
Yeah.
So
yeah, it's very interesting. I think Berkshire Hathaway and Tesla stand above all others in that you are buying the man,
right,
when you buy the company. And I mean, like, Tesla will move on SpaceX launches and like all these other things that Elon is doing, and it just is very interesting sentiment and vibes. But yeah, let's get into it here. This is hot off the press, guys. They just disclosed this position after market close today, so we'll catch you up a little bit. So yeah, UNH having a bad year, 46% drop in share price year to date. It was more than that. Just a few weeks ago, they've been gradually climbing up a little bit. They issued a dividend recently that gave them a small bump. Lowered profit forecast, billions in expected additional costs, ongoing federal investigations, fallout from a cyber attack, and reputational damage from a high-profile executive murder case, which, yes, their CEO was assassinated. That was the first part of this issue. And then when literally the very worst, most parabolic thing that could possibly happen to your company was going on, all of a sudden the government was like, oh, man, there's regulatory concerns here, which sent UNH down even further. But the reality is that, and my sentiment in getting involved with UNH, 2 months ago now, was just that this company isn't going anywhere. Right. They're still strong. It's turbulent in its turnover, and they might have to pay some fines, but eventually it was going to return to those higher highs. I was never expecting a catalyst like this. My sentiment the whole time was I took calls 18 months out, and I was just going to wait and let it slowly creep back. Good gamma. And now, suddenly I've gotten a huge bump.
No, so. I mean, especially with a case like this and somebody like Warren Buffett. Warren Buffett is known to be a very investor savvy, very kind of safe, kind of I make smart bets kind of guy. And he's kind of known for that. It's built into his brand. With all the chaos that's happening with UNH, it's like, wow, Warren Buffett's getting involved in this, and this seems so chaotic, and it doesn't seem like Warren Buffett typically sides on the air of chaos. So for him to get involved again, kind of surprising to me, but exciting to see the stock pop off over 20-something points. So, I mean, if you were short, I'd be patient on checking that portfolio in the morning, but I mean, if you're long, definitely go check it out right now.
Well, yeah, and it's very interesting because, I mean, I think Warren Buffett is arguably, if not just certainly, the greatest investor of all time.
He's like the Michael Jordan.
Exactly. And with that must come contrarian sentiment a lot of the time. I mean, you're going to have to be contrarian pretty often to be as good as he is, and this is about the most contrarian thing you could possibly do right now. Nick Batista described it as a deal with the devil on an interview that I did with him for TikTok, and it's true, man. Buying UNH right now, it does feel like making a deal with the devil. Everybody hates this company. If you're talking about in the market, everybody hates this company's performance. Outside of the market, everybody hates this company on morality. It's a bold move.
I mean, I think it's an interesting one, and we can go ahead and jump to the next slide here. But also, I think it's funny by how sometimes our own individual biases can absolutely sway financial decisions and in terms of what we want to get involved with. I think we were talking on that topic, I think earlier the year with the whole fiasco with Elon Musk. Elon Musk kind of started to become more of a controversial character. It's almost like he stepped into that role. There's no way he's not smart enough to think about that's the role he's stepping into.
Elon Musk, he tests the limits of no such thing as bad publicity.
100%. Elon Musk is so calculated with everything. Everything he does, I'm like, he had to have thought about the potential outcomes and scenarios of this. There's no way he just did something off a whim.
You guys, Omaha, and you guys with this HIMS conversation in chat, this is making me laugh, but I can't read any of your things out loud. This is UNH's price action since this news broke. This is all aftermarket today. What is this? 1 minute candles?
1 minute.
Yeah, 1 minute candles into market close today.
I'm sorry. This might be the 5. We'll double check on that, but it's an intraday chart.
Very short time frame.
It's an intraday chart.
Yeah, I mean, you can see the furthest time we can see back is 9:30 a.m. this morning. So this is today's 5 minute chart on UNH. Can you guys look at this chart and tell me where in the chart you think Berkshire Hathaway disclosed their holdings of UNH? I know it's really hard, but I really believe in you guys. We have a very smart audience, and I think you can probably figure it out. Big move up for UNH. It's just continued to climb. I think it's reasonable that this thing opens over 300 tomorrow. It's the title slide says it all. Midas has touched this now. It is gold. So I think everybody's going to be scrambling to get on that train. Fortunately, I booked my ticket 2 months ago. Tell us the timeline.
Just a little bit of a timeline and context. I can't even believe this was in December. It feels like it was just a few months ago. But December 4th, 2024, right? We had the United Healthcare CEO Brian Thompson. He was shot in the back of the head. I think we had a little bit of that video footage that was going around, but that was in December. Feels like that was just a few months ago. I was
going to say the opposite. That feels like forever ago.
Doesn't
I think.
Feel forever ago?
Oh yeah,
it does.
I mean, it's just, and that's sort of just a personal thing in my life. It's like, if you talk about events that have happened, like in my life, I was in college finishing up finals around this time, and I have graduated, went to South America, moved to Chicago.
You're a local now.
Yeah, so it's a lot can change. A lot can change. It feels like a lifetime ago to me.
It's a fast timeline within this timeline right here. So
thank you, Theta Trader. Line go up, Gus. He says, Kirk, that is absolutely right. Ding, ding, ding.
December 9th, just a few days after, Luigi was arrested in Pennsylvania with a ghost gun and a suppressor and a false ID. It always blew my mind when I learned about the black market for the first time, and I heard you could hire like hitmen, you could buy this, you could buy that. I mean, certain organs, pretty much anything you could.
Literally anything you could. People. Anything you can think of.
I mean, quite literally. So he did have a ghost gun. Probably has to do with some type of black market of the sort. Early 2025. He was formally charged with murder, terrorism, prosecutors looking to seek the death penalty. Mid-2025, UNH stock declines amid legal, federal, and operational issues. Buffett quietly accumulates shares, right? He's somebody that does not do things for the attention. If he could backdoor his way out of everything, he would. He's very quiet. But August 14th, he's not able to be quiet with these footsteps because they have such massive position sizes that they're trading with. Berkshire revealed 5 million shares, 1.6 billion stake, sparking a massive run in the underlying after hours. So we clearly see the visual for that, Gus. I mean, I don't know. UNH feels like it was one of those underlyings people were figuring out how the market was going to digest this thing and how it was going to play out. And it feels that with Warren Buffett, kind of being the first one to be like, okay, I'll go ahead and do it. I'll be the one. It gives others the confidence to go ahead and start pulling the trigger and managing their positions however they would want to.
Yeah, obviously a very heavy thing. I don't mean to make light of it, but I, in a purely market context, was actually excited to get involved with UNH after the CEO assassination because fundamentally that doesn't change anything. I mean, you're going to have to find new leadership, which creates a little bit of turbulence, but it's not going to hurt your core business at all. But yes, the regulatory stuff that happened later on and drove them to even lower lows, that was a little bit alarming, and I think that at least for myself and I'm sure many others, that was what actually put them fully off of this stock. It's just this is too much stuff on fire for me to try to touch. But yeah, eventually I was convinced by the bad influence that sits to my right. That's not you on my other side. And got long some UNH, and I'm happy with it now. It's been a lot of pain. Do not get me wrong. Being long UNH over the last 2 months has been nothing but pain to this point, and I am down massive on the position. But we're finally getting a little vol spike here. Premiums should be juiced. The gamma's going to come into play.
Gamma's going to gamma.
Yeah, so I'm happy with it.
Yeah.
But yeah. Last slide here.
The infamous
Luigi Mangione. Mangione, I don't know. I've actually never heard this man's name said before.
I think Mangione sounds about right.
I've just read it 100 times.
He's Italian.
Yeah.
So anybody else Italian want to listen?
Luigi Mangione. I wonder where he might be from. Yeah. But anyway, yeah. 26-year-old Ivy League graduate, valedictorian at his high school. He was apprehended in Pennsylvania. The assassination happened in New York, correct?
I'll double check on that.
I'm reasonably certain happened in New York. He had fled to Pennsylvania. They found him in a McDonald's there, which I always thought was an interesting little part of this. And it was because somebody in the McDonald's called in and said that he looked like the guy. Yeah, New York. But yes, he is alleged murderer of United Healthcare's former CEO, and they are seeking the death penalty due to the severity and potential broader threat to the healthcare industry. Morals aside, I can see why they feel the need to pursue the death threat here, because if you give him anything less, you're going to set the benchmark right here. For
exactly, he's going to be used as
CEO.
Absolutely, yes. He's going to be used as the example.
Yeah. So if you go too light, other people might see that as opportunity. So it's very interesting.
Yeah.
But yeah.
No, I mean, it's always funny seeing this picture pop back up, but at the same time too, I know a few months after that, he had released something along the lines of, wasn't there some type of eerie message that was left later on, like you will eventually see, or
he had a manifesto.
That was in the manifesto, I think it was, right?
Yeah, they found him with a manifesto on his person.
Yeah.
And yeah, I remember that got out. And now he manages to get like a lot of press from prison. I don't know who's doing all this, but like I've seen tons of like the letters he's written back out to people, the letters that he's receiving in there, comments from him from behind bars. I don't really know how they're making that happen, but
one thing that I think is pretty crazy too is like allowing, based off of what he does, like everybody gets to form their perception of this guy, right? But the thing is that, like, it's such a weird spot to be in, like allowing the public or allowing whatever, and celebrities have dealt with this and done this all the time, but allowing the public to construct how everyone and everything perceives you, you know? So I always think it's an interesting thing when you do something to where you're not gonna be able to really explain yourself. I mean, I guess that's why they have the manifestos and whatnot, but just having no control over his own narrative is just kind of a weird.
Yeah, and even with the manifesto, like, there's no guarantee that you're ever gonna be able to, like, get that out. Like, how?
Yeah, absolutely.
Yeah.
If anything, there could have been manifestos covered up that we've never got to see because of whatever other issues that could cause.
Yeah, Theta Trader, to your point, I also, and I know that this slide greatly contradicts that, I also wish that we wouldn't give these guys any airtime. This guy is simply so famous that I decided to just go ahead with this slide. But yeah, holistically, mass shooters, murderers, anybody of the sort, I don't think that we should ever give them a single ounce of airtime or oxygen. I don't think we should say their names. I don't think we should be posting their pictures everywhere. This is an extenuating circumstance, but I agree with the sentiment. What's going on, Luis? Happy to see you.
What is
By the way,
going
happy to see everybody. Big Deal, Lone, Theta Trader, who else?
Emmett.
Who else is here? Emmett. Kamal. Good to see all of you. Happy to have you.
I hope everybody was long UNH, and I hope everybody's been having a great week.
Jackie, I heard he wanted trial by combat. Is that true? Is that? Can we get a fact check on that? Somebody give this guy trial by combat if he's requesting it.
We would have heard about his death if he was gone, so I think he won.
You think he won? Well, I mean, trial by combat would just be like, if he lives, he gets to walk.
Right. I think he could be walking.
I mean, I think he's they still got him though. he's still locked up. 3. Who do you even combat with? Who? I have so many questions. Who?
That's the last question I want to ask, and they bring out the guy that you got to combat.
Yeah, he doesn't get to pick. What if they roll out like Khabib Nurmagomedov and he's got to fight Khabib right now? Like, that's interesting. Trial by combat. Give it to him. Let's
give it.
Just let the American public vote on who he's going to fight. And give it to him. Let's test the 100 men versus gorilla thing.
Perfect example.
Yeah, we need a gorilla. I think those are pretty easy to source.
Yeah.
And then 100 death row inmates.
Yeah.
And the whole issue with the gorilla thing is always like, oh, are they going to be trying their hardest? Like, do they have to kill the gorilla? Yeah. Let's get a bunch of death row people.
Yeah.
And they will try their hardest.
I mean, I think naturally, right? Let's break it down. Let me just ask you right off the bat. I mean, 100 men or one gorilla.
Oh, the gorilla.
Okay.
Unless I could sit there and like
regular size gorilla.
Yeah.
Average.
Like a male silverback gorilla.
Yes. He's like, I just want to clarify. We're talking about silverback.
Yes.
You know what a silver.
The specifications are important here because it's a lot of nuance. I think that there is a group of 100 men that could be compiled that could beat the gorilla. But if you randomly select 100 men from the Earth or the United States or whatever, the gorilla's going to.
So we're gonna have to use averages in this data set. So average 100 men, one average silverback gorilla. We're choosing the gorilla, even with like a strategic game plan prior to that.
Well, yeah, yes. Okay. They get their hands and nothing else. They don't get any weapons.
Right.
So I don't really know how you're going to even damage the gorilla in the first place.
Right.
And your numbers are going to be ever thinning as the fight goes on. I mean, there's maybe an angle of like if you just dogpiled, try to just do like an overwhelm situation. But even then, I don't think you could kill the gorilla.
I mean, if you can get the gorilla down on the ground, on its chest or its back or whatever, thing's got a chance. I mean, someone's going for the eyes, somebody's going for the neck, somebody's going for. Damn, I don't even want to put my hands near the face of the gorilla.
Well, yeah, the gorilla will bite your hand off.
You're in fight or flight at that point, and you're probably seeing black in that moment.
Well, yeah. I mean, my thing is like, what's the kill shot? How are we going to put this thing out? I don't think anybody can choke out a gorilla.
How strong is a gorilla's neck? Because it's like if you can get someone to just close off the airflow.
I mean, I think a gorilla's neck's got to be like.
It's got to be. Well, how thick is it?
I mean,
I just haven't done the research on the anatomy of a gorilla. You know, I would assume these are extremely, armored.
What do we want diameter? 36 inches in diameter, like straight across. Like if you were to cross section.
Wide neck.
Yeah, I mean that's like.
Gorilla's neck is like 2.5 feet.
Yeah.
3 feet.
3 feet on the
neck.
Yeah.
Gosh.
It's a big gorilla.
Yeah.
Yeah, so I don't know.
Oh.
we've gotten a little off track here, but
we'll catch up.
10 gorillas versus 1 orca. See, now what's the playing surface? Where are they fighting? Because the orca wins in the water. The gorillas are going to win if it's on land. We're talking about like a shallow pool situation. I don't know how we create a level playing field for those. 2 gorillas, 1 orca. Okay, we just went. Oh, you guys just made the same joke at the same time. Nice. Oh, I see what you were saying, Lone Sofos.
Literally at the same time.
Okay.
Yeah, I'm still gonna go with the 100 men, just because I do think it can get overwhelmed. I do think somehow, some way, we can close off the windpipe. But will we be able to do it long enough?
There would need to be coordination in a flood, because if you let like 20 guys get off first,
very well thought out.
Yeah, because you got one shot. As soon as the gorilla has like 20 of you dead, you're cooked.
Yeah,
you need the full strength of your numbers.
Yeah,
but yeah, I say let's get all the death row inmates, have them fight a gorilla. They get freedom if they beat the gorilla. If not, they are on death row anyway. And like pay-per-view. Let's stream this. Let me bet on this.
You know what's crazy? It sounds so crazy, but this was literally happening 100 years ago, like 150. You know what I'm saying? These things were literally happening.
This is exactly what the Romans did. I mean, the Colosseum was just a bunch of prisoners that they made fight large animals for their freedom.
Yeah.
We used to be a proper world, man. Those were the days.
The days, indeed.
Those were the days. You steal something from your boy, and suddenly you're fighting a lion.
Bro, literally. I mean, there was not a lot of stealing going on around that. But no, we are going to be coming to a close here. Really looking forward to the show tomorrow.
Yeah.
Anything else to add before we start to wrap up here? UNH on the move.
Yeah, UNH on the move. I am long. Genuinely, I think UNH, this is the beginning of the move back to like 400 or 500 levels. I think that the fundamentals have been fine this entire time. There's still regulatory uncertainty, which, uncertainty is never great. But I think that this is enough momentum to finally get a little bit of steam back into the stock and see what happens.
I agree. See what happens tomorrow. We'll be managing those positions. We'll be keeping an eye on the overall
excited
market.
To see you all tomorrow. If you're coming to the Chicago event, I will be there bright and early and for the whole time. Come find me, shake my hand, let's take a picture.
Absolutely, it'll be a good time. Everybody rest up. Hope everybody has a good night. Thanks for taking the time to hang out with us today. We will be back tomorrow at the live show. We'll see you guys in the next one. Peace.